Hey there, REIT enthusiasts! Welcome back to our channel where we dive deep into the exciting world of real estate investment trusts. Today, we have an epic showdown featuring four heavyweight champions: Vici Properties, Prologis, Realty Corporation, and American Tower Corporation. We're breaking down their key financial metrics, explaining what each one means, and comparing them head-to-head to see who comes out on top. Stick around because this is going to be a roller coaster of insights and numbers. Alright, let's kick things off with our first metric: price to adjusted funds from operations trailing 12 months or P/AFFO TTM. AFFO is crucial for REITs as it adjusts funds from operations for maintenance costs and other non-cash items, giving us a clearer picture of performance. In this case, Prologis has the highest number with 21.84. reflecting a premium valuation, while Vici Properties offers the most attractive entry point for value investors at 12.83. If you're hunting for value, Vici might be your pick. But if you're all about that premium shine, Prologis is your go-to. Additionally, over the past 5 years, Prologis has maintained a strong average, suggesting consistent investor confidence, and all four are below their 5-year average, suggesting a potential current undervaluation. This historical perspective helps us understand how these REITs have performed through market ups and downs. Looking ahead, Prologis continues to shine with a forward P/AFFO of 23.92, but Vici Properties offers the best forward value at 12.48. Future projections are crucial for planning investment moves for the coming years. However, after entering the expected growth into the formula, it can be seen that Vici Properties and Realty Corporation appear well valued with values of 1.29 and 1.81 respectively. Whereas Prologis and American Tower could be slightly overvalued with values above 2. Remember that values below 1 are when investors believe a stock is vastly undervalued. Realty shows the highest insider ownership with 1.82%, which can indicate strong confidence from within the company. Higher insider ownership aligns management's interests with those of shareholders, a good sign for potential investors. Continuing with returns, American Tower is the clear winner here with a stellar return of equity of 43.68%. This means they're exceptionally efficient in using equity to generate profits, a great indicator of financial health. Moving on to return of assets, here is Vici Properties, who leads with an ROA of 6.01%. showing they're the most efficient in utilizing their assets to generate earnings. Finally, Vici Properties again takes the top spot with a superior return of invested capital, demonstrating they make the most out of their invested capital. Investing is all about getting those returns. In general terms, I would say that Vici is the one that has more stable and consistent numbers, while Realty should improve them if it wants to continue competing in the market. Another very important metric in real estate investment trusts is the outstanding shares, since to finance their growth and buy more properties they can resort to both debt and the issuance of new shares. Currently, with the highest interest rates, the latter may be the best measure, since the financing conditions in the debt market are very high, which translates into a drop in the returns obtained. In this case, we see how the four companies have increased their shares in circulation over the last decade, although it is clear that Vici and ADC have done so to a greater extent with a compound annual growth rate of 28.36% and 20.64% respectively. This situation can be due to the fact that they are smaller REITs in capitalization and apparently with greater growth potential. But when speaking about shares outstanding, it's important to remember that high growth in shares means a potential dilution of existing shareholders, while reducing them, the shareholder is gaining value in the company, since with the same shares he would have a greater part of the company. So this enormous growth cannot be considered good, rather bad. American Tower stands out with the highest AFFO per share at 10.12, indicating strong earnings potential. More AFFO per share means more cash flow for you. However, another important metric is how fast this AFFO per share will grow in the next few years. And here Vici Properties leads in projected growth, hinting at robust future performance, although the other three companies are very close in projected annual growth rate. Furthermore, When we take into account the growth over the last 5 years, it might seem that Prologis is the best REIT. But if we take into account that both Vici and Agree Realty have considerably increased their outstanding shares, then in absolute terms it is Vici that has increased its adjusted funds from operations the most, while the result of American Tower is not entirely good. Regarding free cash flow per share, Prologis is once again the best with a surprising 15.03%, while ADC, Vici and AMT have had single-digit growth. The four companies suggest great robustness in the growth of their free cash flow, which can mean greater security in future dividend payments without using debt. Now, for all you dividend lovers out there, starting with the highest dividend payer Vici. This REIT offers a dividend yield of 6.03% with quarterly payments of $0.415. Over the last 5 years, dividends have grown at a compound annual growth rate of 7.62%, which is pretty sweet. The industrial REIT, Prologis, offers a dividend yield of 3.51% with quarterly payments of 96 cents. Over the last 10 years, dividends have grown at a compound annual growth rate of 11.61%, so we have less initial yield than Vici but better annual growth. Continuing, Agree Realty Corporation offers a dividend yield of 4.89% with monthly payments of 25 cents. Over the last 10 years, dividends have grown at a compound annual growth rate of 5.93%, less growth and initial yield than Vici, suggesting that the monthly payments are what can make this company more attractive, making dividend reinvestments more frequent. Finally, American Tower has the lower initial dividend yield at 3.37%, with quarterly payments of $1.62 and being in doubt near future dividend increases. In contrast, during the last 10 years it has grown 18.22% annually. Operating margin is like the pulse of a business. It tells us how much profit a company makes from its core operations before paying interest and taxes. A high operating margin means the company is super efficient at turning sales into actual profit. Vici Properties is killing it with an astonishing 92.54% operating margin. That means for every dollar they bring in, they keep almost 93 cents after covering their operating costs. Next up, we've got Agree Realty with a solid 49.17%. Not too shabby. They're doing a great job at keeping costs low and profits high. Think of Agree Realty as the steady marathon runner, consistently pacing themselves to stay ahead. Prologis comes in at 39.61%. While they might not be breaking records like Vici, they're still performing well. Prologis is like that reliable team player in soccer, always delivering solid passes and making sure the game goes smoothly. And then there's American Tower at 34.87%. Sure, it's the lowest of the group, but still respectable. Profit margin tells us how much of each dollar earned by the company is pure profit. A higher profit margin means the company is super efficient at turning revenue into profit, which is what we, as investors, love to see. It's a sign of financial health and efficiency. Holy moly! Vici Properties is taking the cake with a whopping 70.13% profit margin. That means for every dollar they earn, they're keeping over 70 cents as profit. Next up, we have Prologis with a respectable 38.66% profit margin. They're doing a great job too, keeping almost 39 cents of every dollar they make. Prologis is like that solid, reliable bakery in town that everyone trusts. Agree Realty comes in with a 29.51% profit margin. They're still doing quite well, keeping almost 30 cents of every dollar. Agree Realty is like your favorite neighborhood cafe that's consistently good and always there when you need it. And then there's American Tower at 18.42%. While it's the lowest of the group, it's still making a profit. American Tower is like the scrappy food truck that's always on the move, finding new ways to make money and grow. All four companies show positive evolution in revenue and earnings over the last 8 years, although they have underperformed the VO in total return over the last 5 years. Growth in revenue and earnings is a good sign of a company's health and potential. Debt to EBITDA shows us how many years it would take for a company to pay off its debt using its earnings before interest, taxes, depreciation, and amortization. In simpler terms, it's like asking, how many years of my salary would it take to pay off my car loan? American Tower, you've got some explaining to do. With a debt/EBITDA of 7.31, it means it would take over 7 years of their EBITDA to pay off their debt. On the flip side, Prologis is the leanest here with a debt/EBITDA of 4.36. That's more manageable, like a 4-year loan. Prologis is like the smart borrower who knows how to keep their debt in check. Vici Properties and Agree Realty are in the middle of the pack with 5.12 and 5.01 respectively. They're like the sensible borrowers who can handle their debt but still need to keep an eye on it. Next, we have debt/free cash flow. This one tells us how many years it would take to pay off debt using the company's free cash flow, which is the cash left after all expenses, investments, and dividends. It's like asking, how many years of my leftover money after bills and fun would it take to pay off my loan? American Tower again is carrying the heaviest load with a whopping 14.72. That's like having to save up your leftover cash for almost 15 years just to pay off your loan. Vici Properties is next with 8.02, which is still quite high. That's over 8 years of free cash flow. Vici needs to be careful not to let that debt spiral out of control. Prologis and Agree Realty are again more balanced with 6.45 and 6.07. These two are the smart savers, ensuring they don't let debt outpace their ability to pay it down. So, why should you care about these debt metrics? Because high debt levels can be risky. If a company has too much debt, it could struggle to pay it back, especially during tough economic times. Low debt means more flexibility and less risk for investors. Over the trailing 12 months, all four have faced recent downturns, with American Tower experiencing the steepest decline of -17.41%. But remember, downturns can be buying opportunities for savvy investors. Prologis has the largest market cap, reflecting its dominant position. Size can provide stability and influence, but don't discount the smaller players. American Tower is also a big player in this sector, while Vici and Agree Realty are more modest with a market capitalization of $26.4 and $6.5 billion respectively. Finally, let's touch on analyst price targets and fair value. Analysts predict that in the next 12 months, the stock prices of 3 of them would have an upside of more than 10%, while for American Tower they are suggesting a more reasonable price with 7.19% upside. Current prices for these REITs are attractive based on their fair values, but always do your own research. Analysts offer valuable insights, but your own due diligence is key. But are you saying what my ratings are? Well, I consider that Vici Properties has a fair value of $39.75 and adding a safety margin of 15%. A correct price to pay is $33.79, which represents an undervaluation and a price below analyst expectation. Continuing with Prologis, for me it has a fair value of $124.89 and adding a safety margin of 15%. A correct price to pay is $106.16, which represents a current fair valuation of the stock. Finally, we have Agree Realty with a fair value of $71.84 and adding a safety margin of 15%. A correct price to pay is $61.06, which represents a fair valuation of the stock. And what about American Tower? It has a fair value of $233.75 and adding a safety margin of 15%. A correct price to pay is $198.68, which represents a current fair valuation of the stock. There you have it, folks. An in-depth, head-to-head comparison of Vici Properties, Prologis, Agree Realty, and American Tower. Each REIT has its strengths and weaknesses, and now you're armed with the knowledge to make an informed decision. Which REIT caught your eye? Let us know in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Until next time, keep investing wisely.